Bismillah ar-Rahman ar-Rahim. Today, inshallah, I'm going to talk about the reflection of stock dividends and stock splits on the stock price, which is very important. And then we will talk about the repurchase of stock, the stock dividends plan, and after that we will focus on how we calculate the stock return and the valuation of stock, which is our subject in today. Just to remind you on the reflection of stock dividends or stock price, the stock dividends on the assets and liabilities. As I said in the previous meeting, there is no impact on the stock liabilities and the stock assets, but the reflection on the stock price if we have stock dividends. And I think I give you this example. If you look at this example, a 10% stock dividends, okay, what is the impact of a 10% stock dividends on the stock price? The impact is like this. We have the pre-price and we have the post-price. اوكي طيب نيجي نحكي في الستوك برايس كيف بتاثر how the stock price influenced by the stock dividends. Let's take the example. If a company decide to pay stock dividends 10%, so what is the implication of the stock dividends on the stock price? 10%. The equation is very simple. The price, I mean the pre-price, divided 1 plus the rate of dividends, or what they call this is the payout ratio. Payout ratio. So the payout ratio, or the dividends, the stock dividends ratio, stock dividends ratio is 10%. So $20 divided by 1.10, which is equal 18.18. Okay, let's take another example to see how things go. If a stock dividends was 2-1. I will explain what this means. 2-1. And the pre-price or the previous price was $150. What is the price after stock dividends? Okay, so first of all, you should know how to read 2-1. So what it means 2-1, it means, yes, 2 dividends for 1 share. 2 dividends for 1 share. So how you calculate this? Okay, try to do calculation then. So what is the price? Be careful in this example. I give you 2, not 10%, which has different calculation. How we do the calculation for this one? Okay, it's very simple. just multiply the 150 times 1 divided 2, which is $75. Okay, so in the previous example, we have 10%. Okay, what it means 10%? It means each 10 stocks receive one stock, which is like this: 0.10 to 1, 0.10 to 1, or 1 to 0.10. It means each one stock receive 0.10. Okay, let's take this example: 1 to 2. Each one stock receive 2 stocks. Okay, take another example: 1 stock receive 4 stocks. Okay, just start from the right. 1 receive 4, 25. I'm asking about the price now. I'm not asking about the number of shares. I'm asking what is the price. What is the price? I'm not asking what is the number of shares. So I'm asking now about what is the price. We will go back to see the number of shares. Okay? So what is the price? The price is divided by 2, or multiply by 1 divided 2. Okay, let's take another example, just to take more examples. Stock dividends 1 to 4. You know what it means, 1 to 4? One stock receive 4 dividends. The price was $200. What is the new price? Okay, do your calculation. What is the new price? So it's very simple. Either you do by 200s times 1, 4, or 200s divided by 4. Okay, which is $50. Okay, give you another example. Okay. This 10%, yes. Kevin, leave this. Focus on this now. Okay, the stock price dropped by this. Okay. Okay, take another example. Okay. Okay. If the stock dividends 2 to 3. Okay, 2 to 3. The price was $150. What is the new price?
100.
100?
Yes.
50 times 2 divided by 3.
100.
Okay, so 100s. Or it's just 100 divided 3 2, which is 100 times 2 3. It is the same. Okay, let's take another example. The stock dividends. Now we'll take another example, but considering the number of shares. Considering the number of shares. In the the number of shares was 100. Okay, this is the number of shares outstanding, and the price was let's see 150. If the company have stock dividends 1 to 2, it means the number of shares will multiply by 2. So the in the past we will have 200 shares, okay, but the price is dropped by $75 because it's very simple. 150 times, so it is $75, which is $75. Now let's have the market capitalization for the two scenarios, for the pre and for the post. For the pre, it is 1,500. For the post, it is 1,500. Okay, just time 275, 100 times 150. What I mean, market capitalization, it means the number of shares outstanding times the price. Market capitalization, just revise the previous chapter. Market capitalization equal the number of shares outstanding times the price. Then we have the number of shares outstanding in the pre times the price, okay, which is 1,500. In the post we have 200 stocks because the stock dividends, and 75. Now, so what is the importance of the stock dividends? Why the stock dividends for the business? When the company has high rate of return, the return earnings, it is preferable to pay stock dividends. In the case the company has no opportunity to invest, this is the case. Okay, and the importance of the stock dividends as well is decrease the price. And what is the implication of the lower price is increasing the turnover of the stock.
Yes.
The turnover of the stock. Look at here. If we have, for instance, $300, we only may have two stocks, but in this case we have 4 stocks. So from the investor point of view, investors prefer to have more stocks than having less stocks. Okay, and this is increasing the turnover of the stocks. Companies, they do prefer having lower stock price, because the lower stock price increasing the turnover. The turnover is calculated like this. The trading stocks, the number of trading stocks divided the number of shares outstanding. This is the turnover of stocks. And it measures the activity of the stocks in the financial markets. So whether to know the market is active or the stock is active or not, you go to the calculations of the turnover. Turnover. Okay, turnover. So turnover, it means how many times we buy and sell the stock. Yes, when it's increased, it means it's healthy for the business. So the number of stocks traded in the stock exchange divided by the number of shares outstanding. If we have in here in the denominator, if we have more stocks, it means we have high turnover. Okay? And this is a good measurement on the stock trading activity. Okay. In 24th of April, last week, the Bank of Palestine paid stock dividends and cash dividends. 9% for stock dividends sorry, 9% for the cash dividends and 12% for stock dividends. And before they do this, or before they have this, the price was at a particular price, then is dropped to the a new level. Okay, so this is the idea of the stock dividends. Any question? I explained the stock split, but we don't know why companies, or did we? No. Okay, so the stock split. The stock split is similar to the stock dividends. It's a similar idea, but companies, why they do the stock split? Because to activate the trading volume. Just the only difference between the stock dividends and the stock split, the stock dividends is paying from the retained earnings. Okay? For the stock split, is just they only split the stock. Okay? It has no implication on the assets, on the liabilities, or and in the market capitalization. The only implication is on the stock price. And why companies they do this? They do this to reduce the share price. Particularly when you're having a company, I know company is $1,250 the stock price. The Arab Bank, the price of Arab Bank was $500. So if you have $1,000, you just only have 2 stocks. So people, they don't prefer to hold this stock because they need a lot of money to have 100 stocks. So in this case, the stock is split. In the same idea of the stock dividends. Sometimes stock split 1 to 10. 1 to 10. Because investors, again, they prefer to have lower price. I don't mean lower price, the lower price in the lower market capitalization. Because you are lowering the price or reducing the price, and you're increasing the number of shares. Okay? This is the idea. So the stockholders, they receive more stocks in the replacement of the higher price. Okay? At the end of the day, they have the same market capitalization. Okay? The same implication on the stock price. If we have, for instance, 100 stocks, where the stock dividends 1 to 5, so the new price is 100 divided by 5, so $20. This is the new price. From the behavioral finance point of view, generally speaking, the investors' behavior, they think the price will go back again to its original price. So its original price is $100. So let's take this chart. The price was $100. We do splits, then the price dropped to $20. Generally speaking, investors keep saying the price worth $100. So after that, the price will gradually go to its origin. It's $100. So from the investment point of view, it is more preferable when you're having like this stock to invest your money, because it's gradually back to its origin from the behavioral finance point of view, not from the let's see, from fundamental finance. Fundamental finance saying no, it's not happening because you increase the number of shares and you reduce the price, so it's fair game. But from the behavioral finance, it is not fair game, because investors keep observing that this price worth $100. Okay, so when the Arab Bank split their stocks, within 1 or 2 years back to its origin. The origin is $100 or 200 or 400. Okay. So if you are in the news and you know companies having stock splits and stock dividends, So don't get confused of this policies, because companies, they want to activate their financial markets and to improve the turnover activity. I have little question. I have little question for the stock splits. What is the implication of the assets and liabilities?
Nothing.
No implication. What is the implication of the EPS, earning per share? Yes. This is very little question, just to check your understanding. What is the implication on the EPS, earning per share? Increase or decrease? Okay. Are you sure? You said increase. Increase. Who said decrease? Any evidence? The increase? The number of shares increase. So, if the number of shares increase, it means the EPS decrease. Yes. Yeah. Let's take this example to see. Please focus on these questions. Okay? Please, and please. Okay. Let's see the number of shares on the pre and the number of shares on the post. Okay? If we followed 1 to 2 policy, the number of shares was 100. Okay? And the number of shares then 200. Let's take the net income. Just to remind you, the earning per share, EPS, equal the net income divided by the number of shares outstanding. Okay? Now, so the net income in here, let's see the net income, $50. There is no change, $50. But what did change in the number of shares outstanding? Okay, so the EPS then is equal 50 divided by 100, and here is 50 divided by 200. So in here is 0.50, and here is 0.25. Yes. The face value, I mean, when you are coming to explain this, you will see that the EPS go up, and in this case, the EPS is a drop. But in reality, there's no change. Anyone saying why? The EPS, I mean, when you are compare the results, you will see the EPS decrease, and you think that the net income decrease. But the reality, let's say, for instance, one guy in the two scenarios. The first one, we have Ahmed, for instance. Ahmed's having 100 stocks and then having 200 stocks. Just time this with the 200 stocks and time this with 100 stocks, there is no change. Why I giving you this example? Because sometimes when you observing, the EPS is misleading. You need to go back to see the number of shares outstanding and compare the number of shares outstanding with the EPS and the new number of shares outstanding with the EPS again, and you have the results. Okay? In case you have stock dividends. For instance, let's go back to the Bank of Palestine case. You cannot compare the previous year with this year's because they pay stock dividends. So you have to standardize. How you standardize? You just take the number of shares in the previous year and the number of shares of this year and multiply with the EPS and multiply with the EPS. If you observe the EPS, the total EPS, I mean the number of shares outstanding times the EPS, increase more than the previous one, then in this case you can say yes, the EPS increases. Why are we giving this? Because from the financial perspective, you cannot just only need number. You need to know the policy of the company. Okay, whether they pay dividends, okay, dividends, stock dividends, or cash dividends, or they do stock splits. Okay, and they have different explanations. Okay, let's try to think what is the implication on the BE. Okay, in the BE, what is the implication on the PE? The price earning per share. Okay, so the stock splits does not affect the proportionate ownership, does not affect assets, liabilities, and total equity. Okay? But it do affect on the stock split price, and you have many examples like this example. Now, we talk about the stock dividends, the cash dividends, and the stock splits. Okay, we have some investors. They don't need to spend the cash received from the company. It means you are alhamdulillah, you have money, you don't need this. So what is the policies suggested by the dealers or suggested by companies for for these investors? Dealers or banks or companies, they have things known reinvestment plans to reinvest your cash dividends. Okay, and the importance of this plan is a cheap plan. I mean, instead of having the cash, withdraw the cash from the bank and going to invest by yourself, no, the bank suggests or the dealer suggests to you to put in a particular plan, and you may reinvest this cash in the same business. Okay? For instance, if we have one guy saying to the Bank of Palestine, I don't want the cash. The Bank of Palestine should have a management or a plan to suggest to these investors, okay, we have reinvestment or dividend reinvestment plan. Okay, what is the reinvestment plan? So cash dividends used to purchase additional shares. Okay? For instance, if the price was $5, okay, and you hold 100 stocks, the dividends $1 for each stock. $1 for each stock. So at the end of the day, you receive how much? $100. Or let's say, make things simple, dividends 0.5. So you receive $50. Now the question is, you don't need the $50. What should you do? You can buy 10 stocks.
Yes.
Okay? But you're just subject of some little commission. Just little commission. And this little commission is below the current commission suggested by the market, by the market dealer or by the company. Because this is internally. You don't need to have a complicated process of doing this transaction. Okay? So this is the idea. Cash dividends used to purchase additional shares. So this is the idea of doing the cash dividends. And one more thing, additional cash contributions may be allowed. In addition to this, as well as you are investors and you receive $50 as a dividend, so you're saying, okay, hey, we can pay $100 in addition to the $50. If you have in your bank accounts as a deposit $100, you say, okay, this is $50 coming from the dividends, So I will add another $100, so it's become 150, and you can reinvest then in this company. Okay? Why they do this? Because they want to encourage the investment by using the reinvestment plan policy. Any question? Any question? The beauty of this, expenses often paid by the firm. I mean the commission. It means the investors is only subject to very, very little commission. The companies, they do this to secure the rate of cash.
How to encourage investment.
Yeah, and by encouraging investments.
Yes.
And in the same times, the companies, they have a cheap source of fund.
Yes.
Instead of having this, they have to get loans or borrow money from the banks or to issue shares. But in this case, it has a mutual benefits between the business and the investors. Okay? And this is automated, easy means to save. There is no tough regulations in doing this. Okay? For the reinvestment plans. It's not like the issuing shares, not like the private placement. It's like you are securing the cash to the business with a cheaper price.
Yes.
Or with a cheap cost. Okay? Now, the stock repurchases. You have an idea about this? No? Yes? Stock repurchases. Okay? Stock repurchases. In accounting. You have accounting. Yes? Stock repurchase. Yes. Yes, I know.
Selling the stocks and then with the price.
Selling or buying?
Selling. And then after when the price rises,
Okay. No? What is the accounting people? Huh? What is the accountants? Huh? So what is the repurchase? Repurchase stock. Why are you hiding yourself? Huh? Repurchase, stock repurchase. Okay, the stock repurchase. It is a policy followed by the business when they have extra cash. Okay? If you have extra cash and you don't have that opportunity to invest, so in this case, just convert your cash to buying your shares. That's it.
Yes, salam.
Sorry? So, please explain it again, please, just to see whether I know what you know.
the company has extra cash.
Yes.
And want to invest. They prefer to invest in their own stocks. Therefore, they repurchase and buy their own stocks which were issued earlier.
Yeah. So, from where they buy the stocks? From the secondary markets. It's like anyone. They buy from the secondary markets. Let's ask you very little question. What is the good time for them to buy back the stock? When the price drop. So let's make things like this. When you have extra cash and your prices drop, so it's preferable just buying from your money to to activate the stocks. Okay, this policy it has different implication than the stock dividends and the stock splits. Okay, when you repurchase your stocks, you activate the stocks, so the price is going up. Okay, so the financial manager, they prefer to buy the stock when it drops, and they hit two bears in one stone. Okay, the first thing, they pay little money, and at the same time the price will go up. Okay, by activating the purchase. And when people or investors observe that the price will go up, this is not because of the reality of the business. This is like financial actions, financial decision. So the financial decision make the price to go up. Okay, so the investors, they follow this. They think, oh, the company doing well, and then they buy the price, and then the price will go up again. Okay, so the stock repurchases is important as a financial manager tool to invest inside the business, and it has important when you have extra cash or exceeding cash than what you want. Then it's fine to invest on your business. My little question again: what is the implication of this on the stock dilution? Okay, just answer this question. Stock dilution. Did you come across with this before? I think yes. I'm answering you because I explained this before. First of all, what dilution means? I explained this in finance. Okay, and in investment before 3-4 meetings. If you follow my classes, you will know. Okay, but I know my students, they don't revise this until the exams knock their doors. I know. Yes, you are exceptional. We're 2 or 3 meetings before. No, I'm saying 2 or 3 meetings. Okay, so dilution. What is the implication of في الدبلوم. The stock dilution, increasing the number of shares. Okay. Say it again, please. The number of shares. The dilution is problem. When you have extra stocks or when you are issuing shares, you have a dilution. This is the meaning of dilution. Okay. What exactly now the dilution is the reduction in the EPS as a result of having new shares. Okay? So just make connection between 2 things. When we are issuing shares, all the investors have a problem. What this problem is facing the dilution. So their shares from the income is reduced. So it means the EPS is decreased. In face of this, just to examine whether you understand or you are reading the previous meetings, in face of this, what the companies should do when they are facing up the dilution? Just to remind you, the dilution again is the decrease in the EPS. And then the companies should have some policies to protect the investors. What this policy known, or how they do this? Go back to the previous meetings again. They do preemptive rights. Preemptive rights. And they have offering rights. No? Yes. I know, yes. Just do connection. Do connection between what I'm saying today and what I said in the previous meeting. Okay, let's slide talk. And I explain this. Please, my student, read and revise and read. Let's go back just to remind you. Yes, I said this. I know. I said. I'm not getting old yet. Look at here. Preemptive rights. The rights of current stockholders to maintain their proportionate ownership in the firm. Rights offering sale of new securities to existing stockholders. It means when you issue new shares, the existing investors, they face a dilution. So in order to avoid this dilution, the company gives them right offerings. You have the priority of buying stocks than the others. Why they do this? Because of the dilution. The dilution is the reduction in the EPS, the earning per share. Okay? So please read. It is not my problem, by the way, if you are not reading. Okay, for the dilution, let's take this. Okay? For the repurchase. Pre-purchase and post-purchase. The number of shares, and we will see the net income. The number of shares in the pre-repurchase was 1,000. Then, after the repurchase, the company repurchased 300,000 stocks. So it becomes 700. Now, let's fix the net income. 300,000. So this is 1 million, and this is 700,000. So it means repurchase 300,000. This 300,000 is recorded in the liabilities under in minus, and take the account of the treasury stocks. Treasury stocks. This is known as treasury stocks. Okay? This is for the accountants. Treasury stocks. So what it means is treasury stocks, which is the stocks repurchased by the company, and is recorded in the liabilities but in minus. Be careful, because this is considered as an investment or as an asset. Okay? But because of the accounting regulations, so we have to record in the liabilities under the equity but in minus. Okay. So now net income, let's see, the net income is in here is 1,500 and here 1,500. No change in net income. Now calculate the EPS. Calculate the EPS. What you observe? 1,500 divided by 1,000 and 1,500 divided by 700.
1.5.
So in the first one, 1.5.
2.14.
Okay, so what you observe? So this is against the dilution. The EPS increase. So why the EPS increase? Because we decrease the number of shares outstanding by repurchasing the stocks. Okay? Again. It's very simple. We repurchase 300,000 stocks. So the number of shares become like 700. Okay? And the net income, we fix the net income 1,500s, 1,500s. Now calculate the EPS. The net income divided by the number of shares outstanding. It's 1.5 and here 2.14. What we observe that the EPS increases. Why it increases? Not because, be careful, not because increases in the net income, but because the decrease in the number of shares outstanding as a result of repurchase stocks. Okay? Because some people, when they calculate the EPS, and we're asking them, I think in the last year or the year before the last year, I had a question like this to my students, and I asked them, please comment on the EPS. The majority of the students saying the EPS is increased because of net income increase. No, not because of this. Because the number of shares decrease as a result of repurchase. And I bought the treasury stocks in the statement, and I want to see to what extent my students think from investment perspective, not from just a superficial perspective. Okay? So you can feel the importance of finance. Things not going like this. You can, yes, zigzag. So stock repurchases. Corporations with the cash may reduce the number of existing shares. So we address this problem through buyback programs. Buy back the shares. The decrease in the outstanding shares may increase EPS, increases the price of the stock. And as I say to you, because if you see the prices going up, not because investors buy, because the company buy their shares. Okay, so the external investors are observing, oh, the price going up, so they start to buy, like copying what other investors doing. But in reality, the price is going up not because of the performance, the fundamental performance of the business, because of financial manager actions. Okay, because of financial manager actions, not because of increases in sales, not because increases in the income. Okay? So be careful in finance. We may increase the EPS without any increasing in the net income by playing the game of shares.
Is there any regulation?
Yes, there is a regulations.
But it's not deceitful.
Yes, misleading the investors. The Financial Market Committee, the SEC, they have their regulations on this. And this regulation related to the disclosing. Okay, disclosing this to the investors. But the problem is that not all investors, they know this or access to the particular information. Okay, and you follow some regulations. What about the capital gains? The stockholders do not have to sell their shares. And sales are realized capital gains subject to capital gains taxations. In this case, repurchase, and when you are repurchase the stocks, you are buying and you are not subject to a particular tax. No, it's not subject to tax because this is inside the business. Corporate liquidations. Corporate liquidations are rare, and company ceases operations when companies face some challenges, pays off its liabilities, distributes its remaining asset to stockholders. This is when facing the bankruptcy. Now, in this point, we finished the chapter 7, and the rest of chapter 7 is related to the financial management. If you open page no, we don't need it means just one single thing about the preferred stocks. I will explain the preferred stocks. Yes, in page 282. 282 is related to financial management, and the majority of students have the financial management course, so I don't need to repeat this in investment. It's important for investment, but we don't need this. Which غلط؟ انتوا الاكاونتنتس انتوا انتوا الكبار يعني والله يعني انا اخجل اشرح financial management on the يعني in front of accountants. So the analysis of financial statements is financial management. Okay? We don't need this so far. Just we have little things about preferred stocks. These we have the last things in this chapter is the preferred stocks. Let's explain the preferred stocks. Anyone just give me brief about the preferred stocks? Okay, preferred stocks. What preferred stocks means, and how we invest in preferred stocks. What is the difference between preferred stocks and common stocks? Sorry? Okay. That's brilliant. Let's say what she said, that the preferred stocks guarantees the dividends. This is what you said. Are you sure this is right? Okay. Now let's talk about the dividends. Many questions waiting for you in this point, in particular for the preferred stocks. As she said, it guarantees a particular dividends. This dividends, if we have preferred stock with the par value of $10, okay, and the dividends is 10%. The dividends is 10%. The dividends is 10%. The price or the net income is, let's see, $70. My question is, how much dividends the preferred stocks would receive? So the par value of the preferred stocks is $10. The dividends is 10%. The net income is $70. So calculate the dividends of the preferred stocks. Okay? It's very simple calculation. Sorry? $70, the net income. The dividends is 10%. The bar value of the preferred stock is $10. So what is the dividends of the preferred stocks? So what then? This is my question. 10% of what? And we are videoing this. However, we still some students they get confused from understanding the preferred stocks. This is your final answer. Yes, مستحيل تكون من net income. Yes, you are right. It's impossible from the net income because it receive fixed dividends. So the fixed dividends is multiplied by 10% from the par value. So you receive $1. It doesn't matter what is the net income.
And another reason, net income may be, yes, maybe positive or negative. So
it doesn't matter what is your level of net income.
Yeah.
And this is why it's saying preferred stocks.
Yeah.
So they guarantees a particular rate of the of dividends. It doesn't matter what is the net income rate. If the net income is 70 some things or 100 million or is not related.
yes.
So again, the dividends is fixed. And the dividend rate is a function of the par value.
Yes.
And the par value is not a change. So you keep receiving $1 for a long period of time. And this is similar to the stock known as perpetuity stocks. Go back to the Google and ask Google about the perpetual stocks. It's mean receiving fixed dividends for alpha time. Okay? So this is the important of preferred stocks. Preferred stocks is receiving a fixed dividends from the par value, not from the net income. I repeated this many times just to stress the understanding of this. However, I may see some students, they don't understand this preferred stocks. Okay. One more thing for the preferred stocks. We have cumulative stocks and non-cumulative. Cumulative, it means the dividends is cumulated. If the company failed to pay this year, they will pay for the second year. This is cumulative. The last things is the arrearage stock. Arrearage. What it means? Arrearage. It means if the company failed to pay the dividends, they cannot pay the dividends of the common stocks. So, in order to pay for the common stocks, they have to pay for the preferred stocks first. This case known rearrange. So the preferred stocks have rearrange statement. If you see rearrange statement, it means the preferred stocks are not receiving their dividends. Okay? So this is rearrange. If they pay the dividends, the rearrange is removing. What it means from legal perspective, it means the stockholder will not receive their dividends unless the preferred stocks receive their dividends. The priority over the common stocks. Okay? Inshallah, we will stop here, and this is the end of chapter 7.